the assets that they were picking up is stuff that you wouldn't, it was stuff that 3-4 units that was for 30 to 50K they were picking up. With these things were valued at one stage at 800,000. It's probably back there again. It was nuts. It was a sale of a lifetime, and I didn't have cash. It was Black Friday, and I was broke. I couldn't buy that big screen TV that I wanted. But kidding aside, so what I'm looking at is, and you're 100% correct, it's already drying up on the business side. I can see how it will dry up on the HELOC side eventually. So you want to have capital in a place where you can access it when you're going to need it, because you're going to want access to capital. And just knowing from my past experience, nobody has all the answers. I don't have a crystal ball. I can't predict the future, but I knew what happened the last time. And if it looks similar, I want to have capital in a place that has guaranteed access to a policy loan, like in these life insurance policies. And right now they're at 5.7%. So interest rates are going up. So it's always kept me a better investor too, because some deals are just not making sense right now at that 5.7%. So I just don't participate in them.
Yeah, and when I was talking to experienced investors in March 2020, the one piece of advice they were telling me basically was, if you have any open HELOCs, go cash them out. Go cash them right now. Just max them out. You'll pay your 5-6% on them, whatever it is. Just hold on to them, because you want all that capital. Because the first thing they do, and the first thing they said was, if it's anything like 07, 09, they will freeze them on you, but they can't freeze them if you tap them. So it's interesting. Yeah. The other thing I wanted to mention was, I know on one of the slides you mentioned that they don't come with deductions or policy premiums.
Yes.
Now, how does it work if a lot of people on this call might have a business LLC? What happens if the business LLC purchases these policies for the principal? And then with those deductions at that point, I know you're not a CPA, so you're not giving financial advice, but is that a way to actually get those deductions at that point?
So one of the partners that I work with on business designs, he used to work for the IRS. And so I have learned a lot from him. And the designs that we've come up creatively, always using his kind of terminologies, like, MC, you don't want to play in the sandbox with the government. Have a separate sandbox. So a lot of the ways in which you could get some value from this from a tax standpoint is you set this up separately for you. Your trust owns it. You're the beneficiary of the trust, or you're the investment trustee if it's a domestic asset protection trust. Again, I'm not a lawyer, just giving you an idea here. Or you just own it by yourself. It's separate. Then you can loan the money to your business or LLC and give your LLC or the business a note. The business then repays the note with interest back to you. And that is tax deductible for the business. And of course, you'll get a 1099 because you're earning interest from it. I've never done this personally, just a disclaimer. It hasn't made sense in my tax situation, but it has made sense in certain situations in other people's tax situation. But that's one way of doing it. Now, this high cash value life insurance strategy, where we have had folks that actually deduct life insurance premiums if it's term for a buy-sell agreement, like within the business contingency plan, and there's no cash associated with it. It's purely just death benefit. Then it makes sense to have the business just pay for it and write it off, the same as the disability that the partners would have and other business contingency strategies. But when it comes to cash, as soon as you get the government involved and you take a tax deduction, now you've opened up yourself to a lot of different scenarios which you never wanted to get into the first place by doing the strategy.